We are entering year two of the biggest repricing of global financial assets since the 1940s. The dollar's status as the uncontested reserve asset ends not with a bang, but with a slow, grinding 8–12% annual bleed that forces everything else stocks, bonds, commodities, real estate to reprice violently in dollar terms until the world finds a new equilibrium. Let's walk through the 5 drivers. Driver number 1. The Treasury market is already broken. Foreign official holdings of U.S. Treasuries have fallen for 11 straight quarters. That's the longest drawdown since the data began in 1987. Japan and China are now net sellers on balance. The Belgians, custodian for Euroclear, are dumping $20.30 billion a month. Who's buying? The Fed is still doing QT. Banks are stuffed with unrealized losses and can't add duration. Hedge funds are already maxed on basis trades. 10-year yields north of 6% by summer, maybe 7% if the new administration actually does the full tariff package. That is a mortgage rate in the 9%. Game over for the housing freeze trade. Driver number 2. The dollar milkshake is over. For 3 years, the dollar crushed everything because the Fed was the only major central bank tightening. That movie is done. The ECB, BOE, and BOJ are now cutting or on hold, while the Fed is forced to pause or ease as the Treasury market screams. DXY finishes next year with an 8 handle. That's not a forecast. That's math once foreign central banks stop being forced buyers of dollars to defend their own currencies. Driver number 3. Gold is the new neutral reserve asset. Central banks bought another 1,100 tons last year and are on pace for 1,300 plus this year. At the margin, every ounce they buy is an ounce that does not go into the U.S. Treasury market. Gold to oil ratio is already back to the 1970s average. That tells you the oil states are comfortable pricing energy in non-dollar terms again. My base case: gold $4,800, $5,200 by year-end next year. That's not a trade. That's a wealth preservation necessity for any institution with a 20-year horizon. Driver number 4. Energy dominance trumps tariff pain. Yes, 60% tariffs on China and 25% on everyone else will be inflationary. But the U.S. is now the lowest cost producer of energy on the planet. We run a structural current account surplus in energy. Every factory that reshores or friendshores to North America gets a 40–60% energy cost advantage over Europe and Northeast Asia. Net, U.S. terms of trade actually improved dramatically over the decade. The pain is front-loaded for next 2 years. The payoff starts onward. Driver number 5. The Fed loses control of the long end. This is the part nobody wants to say out loud. The Fed can still cap the front end with yield curve control if they choose, but the long end is increasingly set by foreign investors and global savings gluts fleeing the dollar. We are heading into a world where the 10-year Treasury yield is determined in Shanghai and Riyadh as much as in the FOMC room. That loss of monetary sovereignty is the real regime change. So, what does the portfolio look like next year? Very simple 4-bucket framework. Energy and materials equities, the only sector with pricing power in a world of tariff inflation and de-dollarization. Bitcoin and gold, the only monetary assets that can't be printed or sanctioned at will. Short duration floating rate credit. You get paid to wait while the bond market sorts itself out. Cash outside the United States, specifically Singapore dollar, Norwegian krone, and Brazilian real deposits. These currencies have the best combination of commodity backing and central bank discipline. Everything else, long duration, fixed rate, anything, unprofitable tech, commercial real estate, European equities, is a melting ice cube in this environment. Final thought. We are not going back to the decade prior. We are not even going back to the 1970s. We are going forward to something new. A multipolar monetary world where the U.S. remains the dominant military and energy power, but no longer the dominant financial power. That transition is messy, volatile, and enormously profitable for people who own scarce, real assets and get their liquidity outside the dollar system before the rest of the crowd figures it out. 2026 is the year the crowd starts to figure it out.